Good afternoon. Getting right down to business here. We're doing it live, doing more at 4 weekday afternoons, right after Guy Benson and just before Randy Wang at 5 on the 790 KBC News Blitz. Right now it's Mottek On Money live on the air on 790 KBC, streaming live online worldwide at kbc.com and your on-demand Mottek On Money podcast, kbc.com, Apple, iTunes, YouTube, all of your favorite podcast platforms. Stocks pulling back again today, taking a hit on the disappointing services sector report and more news about tariffs also weighing on the markets. The Dow coming down 62 points to 44,112. The S&P 500 down 31 at 62.99, and the NASDAQ down 137 at 20,916. Looks like NVIDIA slipped from its record high, down nearly $2 at 178 and change. Day after posting strong gains yesterday, all the major averages did pull back. We did see a lower opening right out of the gate on a weaker than expected report from the Institute for Supply Management. The services sector index did pull back in July from the previous month and cooled off more than most analysts had expected. We also got more earnings news and also the news today on tariffs. The latest news on that is that the roller coaster continues. The Wall Street Journal reports President Trump says he will unveil tariffs on semiconductors and pharmaceuticals within the next week or so, and that import taxes on drugs could ultimately reach 250%. In reaction to that, trading partners scrambled to reach deals ahead of Thursday's deadline. The president of Switzerland has rushed to Washington to talk to trade negotiators here in a sweetened proposal to head off a 39% tariff rate for Switzerland. President Trump also focused on India over its ties to Russia, saying he was likely to raise tariffs on Indian goods very substantially over the next 24 hours from a planned 25%. India, meanwhile, the government there is digging in its heels and resisting pressure to curb purchases of Russian oil, despite threats by President Trump to retaliate by imposing higher tariffs on India. We'll discuss that and more with prominent oil industry analyst John KILDUFF at Again Capital and CNBC contributor who will be joining me live later this hour on the India-Russia-U.S. story. Looks like Indian Prime Minister Modi is under pressure to stop selling oil to Russia as the war between Russia and Ukraine continues. We're also watching what's happening in the Middle East. That's back in focus with the Israeli Prime Minister considering ordering the full reoccupation of the Gaza Strip. We'll talk about it, and we'll talk about it with Lisa DAFTARI, Middle East expert and editor of the Foreign Desk. But first, on your money, the markets, the economy, and the whole works now. Joining us live is GABRIEL Wisdom, Managing Director of American Money Management and author of Wisdom on Value Investing. GABRIEL Wisdom, good afternoon to you, sir.
Good afternoon, Frank. You know, the great debate on interest rates and inflation rages on, and everybody has an opinion, and everybody wants to buy a dollar for 50 cents. A dollar's worth of assets for 50 cents occasionally is what you get in the markets, but those deep discounts are pretty rare, especially for high-quality businesses. But with elevated interest rates and above expected inflation, why is consumer spending holding up? It's proven to be pretty resilient so far this year, despite the rise in interest rates. And maybe it has to do with the retiring baby boom generation with a record $84 trillion in net worth. They own $9 trillion, or about half of the deposits in money market funds, according to Yardeni research. And they have a relatively small share of consumer credit debt compared to Gen X and the millennials. Anyway, they're earning interest income, and that interest income, which they hadn't had before rates went up, is creating income disparities, and it's evident in areas of consumer spending. We'll see how retail sales go, but so far the baby boomers are spending money, and it's helping.
Very interesting. What's your reaction to the latest readings we've been getting here? The services sector appears to have slowed a bit. Of course, we got that jobs report on Friday, which led to the firing of the head of the Bureau of Labor Statistics, and of course the Fed meeting last week, where they held the line on short-term rates, and the Fed chairman was still uncertain about tariffs, but it looks like a lot of people are placing the bets now that the Fed will be lowering rates in September. Give us your reaction to these latest developments and readings.
Well, Frank, that's a lot to unravel. I'll tell you
Yep.
that the Bureau of Labor Statistics each month publishes something they call an employment situation report. And that includes employment, the hours worked, wage data for workers, and all of that. But it comes from surveys of businesses that represent different sectors of the economy. And these are the revisions that upset President Trump, the so-called establishment survey, especially, which relies on a survey of about 121,000 businesses and government agencies. And the problem is we see on average 2 revisions because a significant number of businesses are slow to respond to the survey answers. So they become added as they're received. Hence, you get these revisions up or down in the estimates of new jobs. And it's going to be pretty interesting to see how the data pans out over the next couple of months. In the meantime, there's a bit of confusion, especially with regard to tariffs and the Fed.
All right. Given all that, what do you think the Fed is going to do next month? Looks like the Fed futures betting that there will be a cut next month. And with the market here hovering near all-time highs, what kind of reaction might we see for the markets?
I wouldn't be surprised if we get a slight rate reduction. Demand clearly is in sync with supply. There's diminishing demand, especially with the recent slowdown in payroll employment gains, Frank. And it appears to be due to a shortage of workers, not a weakening demand for workers. And so the JOLTS report has been somewhat skewed by this because it's the proxy for labor demand. It's been pretty closely tracking the labor force. I think the Federal Reserve may either hold the line, or if rates come down, it won't be by much.
All right, let's get to some more of the exciting stuff here. We see Bitcoin down about $10,000 from its recent all-time high, hovering just below 114,000 here at the moment. I know you keep an eye and pay attention to what's happening with Bitcoin and the other cryptos these days. What are your impressions there?
Well, it's become widely accepted now, Frank, especially anything that relies on blockchain technology. The banks are on board, and now with stable coins, that helps a lot. There's more regulation and transparency. I read recently there are 20 million Bitcoin in circulation, for example, but most people don't own a whole Bitcoin. There's only 1 million or so wallets that hold one full Bitcoin. Some 55 million of the wallets out there own fractions of Bitcoin and other crypto. And so that's helped support the crypto market. We're seeing these exchange-traded funds and even indexes like the Vanguard S&P 500 own significant positions in companies that have a lot of Bitcoin. So it's very real.
All right, and what about the tech names here that you follow? NVIDIA hitting a record high this week, pulling back today, but hit 180 and it's now about down to 178 or so. We see Tesla pulling back a bit today, it looks like here, and the whole Mag 7 complex. Give us again an update on how you see what's happening there.
Well, long before NVIDIA became the AI, artificial intelligence powerhouse that it is, was working to persuade the world to use its chips to speed up complex computer problems. And now NVIDIA is working to persuade scientists to use artificial intelligence that can take the results of a few, calculations and use them to make predictions on everything from weather to political outcomes. So that's very positive. But the Mag 7 continues to underperform on balance. It represents now about 27% of the performance of the S&P 500 this year so far, whereas over the last few years it was better than 50% of the overall performance was due to the 7 great companies that we all know. Tesla has been a big laggard. Tesla stock is down over 20% year to date. But Elon Musk is saying that his Optimus robot which is part of Tesla, is going to be the greatest thing ever, be the biggest product in Tesla's history. He envisions this Optimus robot cleaning and maintaining Tesla's autonomous cyber cabs, and which would keep the cost certainly of providing the service low. So Tesla needs this Optimus, or it needs something to do better than it has so far. By comparison, Frank, shares of the robot manufacturer Rockwell Automation are up about 24% year to date.
Very interesting. On the air live with Gabriel Wisdom. And we'll continue the conversation here. Gabriel, with AI very much in focus, no conversation is complete with at least mentioning AI. And if you saw the front page article in the Wall Street Journal yesterday, which referred to the pickup in M&A activity, and Apple's Tim Cook alluded to the possibility of some kind of a merger deal for Apple, perhaps down the road, linking it with some sort of an AI entity at some point. What's your view on Apple here, which has been stuck in the mud compared to some of the other names here, and maybe Apple making some sort of an AI acquisition?
Well, I think they can do it. They've got lots of free cash flow. They've got excess capital, excess savings. They're the standard for so much of what we depend on, and they surprised everybody by under-promising and over-delivering on revenue and earnings with the most recent earnings report. Their China sales was something like $15+ billion, and that was more than Wall Street expected, certainly with all the China dialogue. But they're not keeping up with giants like Microsoft and Amazon, Oracle, Alphabet. These companies have poured lots of money into pushing artificial intelligence development and advanced computing ability. It's all going to depend on what Tim Cook and the board there at Apple wants to do, but they can easily catch up, in my view.
All right, we're going to be talking to an oil industry expert later this hour as the U.S. locks horn with India over India selling oil to Russia, or actually India buying Russian oil, I should say. What do you see happening on that front, and are you touching any of the energy names here at the moment?
Definitely am. I like energy. It's been a laggard, and it's absolutely a necessity, and I think we're entering a new, you could call it a super cycle of remilitarization or defense spending. Since the fall of the Soviet Union, U.S. defense spending has become one of our nation's pillars, budget pillars. Nobody, certainly in the current administration, wants to cut defense spending, and much of this involves the defense of oil production and the like. And then we'll see what happens with the tariffs. If the courts soon rule that the president does not have the legal authority to impose tariffs, and some say this is increasingly likely, we'll see big moves in oil, in my opinion, and pretty much all the tired industrial companies.
All right, what about the defense names here, which you follow as well? RTX, for example, formerly known as Raytheon, and the big aerospace giants, the defense names that you follow.
I like them all, even at the current prices. Everybody knows that the world is buying more high technology, more defense. Palantir had a phenomenal day today. It's a cybersecurity, chips, and defense plays, and a number of the Raytheons, the Lockheed Martins. They've depended on other companies for this kind of technology, but that will change. Geopolitics is taking center stage, and that's very, very positive for aerospace and defense.
All right, yeah, Palantir Technologies up nearly $13 today on its earnings news to 173 and change. Certainly, they also got a big deal from the Pentagon recently. At this point, Gabriel Wisdom, let me ask you the big question here. Any specific places where you are putting money now and or taking it off the table?
Well, Frank, there's an old saying that breaking up is hard to do. And a lot of companies resist breakups. General Electric, for example, did for a number of years, and they finally turned it into 3 different separate companies. And those separate companies, in the aggregate are up some 400%. And the problem in the short run with spin-offs and breakups is that they trade below intrinsic value because there aren't enough analysts that follow the new entity that trades publicly. And then there are companies that I'm watching that are likely to be splitting off different divisions. Warner Brothers Discovery, which is very depressed, is prepared to split into 2 distinct public companies. I'm taking a look at that. One's focused on streaming and the other on the legacy cable side. Comcast is spinning out a bundle of legacy media and digital assets. And Honeywell is looking to spin off their advanced materials unit. I'm watching these, and we'll see what happens, but I suspect if the spin-offs sag, I'll be a buyer.
All right, terrific, Gabriel Wisdom. Thank you very much for taking the call this afternoon. There's so much to discuss, and I, as always, wish we had more time. Gabriel Wisdom, Managing Director at American Money Management and author of Wisdom on Value Investing. Gabriel Wisdom, thank you very much for joining us live here this afternoon.
Thank you, Frank.
Out to the freeways we go now on 790 KABC. Mottek On Money continues. Good afternoon. Frank Mottek here. The Dow pulling back today, down 62 points at 44,112. The S&P 500 down 31 at 6,299. The NASDAQ down 137 points at 20,916. Both the S&P 500 and NASDAQ slipping some more from the recent all-time highs hit just in the last week or so. The volatility index moving higher by 2%. The yield in the 10-year note ticking slightly higher today at 4.22%. We are seeing mortgage rates hovering near 10-month lows, so a ray of sunshine for the real estate business, with the average 30-year fixed pretty much at a 10-month low this week. Price of gold hovering above $3,400 an ounce. Right now, $3,434.20 an ounce. Silver just below $38 an ounce. Crude oil futures right now hovering just above $65 a barrel. We'll be taking a closer look at gas and oil prices coming up in the next half hour with prominent oil industry analyst John KILDUFF at Again Capital and CNBC contributor. This as we follow the latest news related to the U.S. putting pressure on India to stop buying Russian oil. Oil company stocks mixed today. BP among the winners, up $1.11 at $33.60. ExxonMobil down 13 cents at 107 and change. Chevron moving up to $2 at 153.04 cents. Taking a look at some of the other big names, NVIDIA pulling back today from its recent record high, down $1.74 today at 178.26. Coinbase taking a tumble today, down more than $20 at $297.99. As we take a look now at the cryptos here, Bitcoin up about $300 now, back to $113.941. That's about $10,000 off its record high that we saw in the last couple of weeks. Ethereum hovering just below $3,600 now. Doge at the moment at 19 cents. Shares of Tesla pulling back slightly today, down 54 cents at 308.72. Microsoft down nearly 8 at 527.75. Pressuring the markets today, more tariff uncertainty and also the latest reading on the economy on the services sector today, a day after posting strong gains. All three of the major averages did pull back, and we actually opened the day higher but moved lower after a weaker than expected report from the Institute for Supply Management. That's the services sector index. The ICM services sector index report came out this morning, which came in weaker than expected. Recent business surveys suggest that activity remains lackluster, according to one assessment from Barclays today. Also, the ISM's reports prices index extended recent increases, reaching the highest level seen since October of 2022. According to the Wall Street Journal, that was a sign of continued inflation pressures, which could potentially make it harder for the Fed to cut interest rates. And it's widely expected that the Fed will be cutting rates in September based on the other latest readings we've seen. The bond market reacted with yields on the 10-year note ticking higher to 4.22%, even as yields on longer-term bonds fell, suggesting investors were becoming slightly less confident about rate cuts and more concerned about growth. On the tariff front, we see the president announcing he'll unveil tariffs on semiconductors and pharmaceuticals within the next week or so, in his words, and that import taxes on drugs could ultimately reach 250%. The president also threatened to raise tariffs on imports from India over the nation's economic links to Russia, although he said the U.S. was getting close to a trade deal with China. We'll take a closer look at all of this coming up in the next half hour here on Mottek On Money on 790 KABC.
YouTube personality Benny Johnson has cracked the code on a new era of newsmaking.
Very controversial, very strong opinions. A person who speaks truth fearlessly, breaking for nobody.
It's a new cultural landscape.
We're not trying to politicize this. People are primed now, and forgive me, dude, it is what it is. Here's what's going on in your country, bro.
The Benny Show.
Get ready if this is something that you needed to put a little pep in your step. No? Yeah? Okay.
Follow and listen on your favorite platform.
Welcome to NFL Flag.
Are you ready? Yeah! Are you ready? Yeah!
No matter who you are, lace up your cleats, smear on your eye black, step out on the field and chase something. Chase a goal.
Let's get it!
Chase the big time.
Get that, ladies!
Chase rings. Chase gold medals. Chase all of it. It's all up for grabs now. NFL Flag. Chase something. Visit NFLflag.com to find a league and start the chase today.
Mottek On Money continues. Here's 790 KABC. President Trump pushing India to stop buying oil from Russia and helping to fund Russia's war against Ukraine. The president also pressuring China to stop buying oil from Russia. Right now, India in focus, with the president raising the issue as he tries to press the Russian leader to agree to a ceasefire. Cheap Russian oil benefits refiners in India as well as China, as well as meeting their needs for energy. So far, they're not showing any inclination to stop buying Russian oil. Following all of this very closely, as well as what's happening here in California with a couple of refineries getting set to close, potentially impacting gas prices here. Let's bring in prominent oil industry analyst John Kilduff at Again Capital and CNBC contributor. John Kilduff, thank you very much for coming to the line here this afternoon.
Great to be on with you as always, Frank. Good afternoon.
Wonderful to have you with us here. Give us your view of this drama that's playing out here with a lot at stake with India and the U.S. Locking horns over this Russian oil.
Yeah, it's interesting, Frank. The public pronouncements from the Indian government are certainly reflective of them bristling at President Trump's focus on them. However, I'll tell you that quietly, and we were able to track all this data via the tankers and the movements of crude oil, around the world from various sources here. And the Indian refiners have actually curtailed or begun to curtail some of their purchases of Russian crude oil. They're actually down now. We're just getting the data in now for July. They're down about 500,000 barrels a day. And even more interestingly, is that they've upped their purchases of U.S. crude oil by about a couple of 100,000 barrels a day. So this has already impacted the Russian crude oil market. The Russian Urals that trade are trading now at about a $4 to $5 discount to the Dubai price, Middle East price marker that we rely on. So the tide could be turning here to a degree and maybe hurting Russia. But I will tell you that it's going to be propping up the prices then of our WTI here, the U.S. crude pricing and the international marker Brent crude oil, because there's obviously now a new buyer on the block that is going to be competing for these barrels. You and I have been talking about this over the past number of months here now, and given all the worries about China and increased output from OPEC, and they just announced a bit of a surprise over the weekend. They topped up their production numbers. OPEC did over the weekend. That should have generated more of a selling than we observed here Sunday night into yesterday in particular. So we're still in the mid-60s, Frank, which is a bit concerning that it's not going down faster, that it's not going down further. So it's something to watch here. One of the things that has kept oil prices in check in the aftermath of the Ukraine-Russia war has been the fact that these Russian barrels have been sneaked out onto the global market really uninterrupted. And that allowed, obviously, other supply then to go other places and balance things out. if we do finally lose the Russian barrels, this whole thesis and theory and outlook about lower prices into the second half of this year could be very much upended. And in fact, we could see prices here be stable to then going higher into the end of the year.
Oil industry analyst John KILDUFF at Again Capital and CNBC contributor live here on Mottek On Money on 790 KBC. That is very interesting. And oil prices have been hanging around in the mid-60s lately. Fortunately, that ceasefire between Israel and Iran appears to be holding, and following the dramatic blowing out of Iran's nuclear weapons program by the U.S. and Israel. So we're watching that very carefully, as well as the latest developments in the Middle East. Do you think we are looking at potentially more upward pressure on oil, given the cards on the table at the moment?
I'm concerned about this Indian situation, Frank. I don't think the Chinese will be responsive at all to the Trump threats. Although some of their independent refiners are potentially vulnerable to secondary sanctions, increased financial sanctions, so that they could demur some Russian purchases. So we are now in here another new dynamic, for the oil market that you and I have been part of now for years. So it is a concerning thing to me. The other issue we have is that demand has been good. And when OPEC has been announcing these production increases over the past couple of months now, and prices haven't given up the ghost, it's indicating to me, and we're seeing this, that there's demand there for those barrels, for those volumes. And the Saudi Aramco CEO today speculated that demand could see a significant upswing in the second half of the year based on their own analysis. So we all, of course, had to take note of that. The market still was down over $1 a barrel today. And I still think, the argument for lower prices persists here overall. But we're going to have to watch if President Trump really doubles down on squeezing out Russian supplies to the global market. Watch out. Like I just mentioned, we will not be heading back down to the low 50s anytime soon.
Very interesting. What's happening here in the U.S.? Is it drill, baby, drill now? And is that helping to keep prices down?
Well, it certainly is. And there's been a little bit of an ebb in U.S. Oil drilling and production, not very much. And it's been in response to, prices where they are now and that had been lower, slightly lower. And also, of course, a lot of the analysis saying it was going to go even lower. So maybe there was a little bit of a pullback. The other interesting phenomenon here that we have to watch out for, Frank, is the one pressure point Canada has in its tariff and trade negotiations with the U.S. is its energy position. We still import about 5 to 6 million barrels a day of Canadian crude oil that really feeds our Gulf Coast refiners. If the Canadians start to sort of toy with that or use that as a leverage point, that could be another factor in driving up crude oil prices. So another factor to watch. So we've gone really from a pretty easy analysis that prices should be heading steady to lower to one where now we've got a lot of little whack-a-mole issues to watch out for, and it's not as certain at all, even though I'm sticking to a sideways to lower market here over the next couple of months.
That is very interesting. On there live with oil industry analyst. It's hard to believe 100 years ago, California, 25% of the world's oil production. We're swimming in oil here in California, but paying some of the highest, if not the highest, gas prices here. And now with a couple of refineries set to close, including the Phillips 66 refinery here in Southern California by the end of the year, and then a Valero refinery to the north of us here also set to close. What's the outlook for Mr. and Mrs. Southern California driver at the gas pump?
Oh, it's not good, Frank. I mean, you could see oil. I mean, you could see oil prices go down to 50 to 40. You won't see much in the way of relief, really, at all. Potentially speaking, when these two refineries go off the board, we talk about energy independence here in the U.S. and what a great thing that has been. How great we see how bad the economy gets impacted by high fuel prices. The inflation, it just rips through everything. Clothes, the grocery store, you name it. It's a bugaboo. And this is going to be a persistent situation for you because you're going to have to be importing gasoline and fuels from the rest of the world. As we've talked about, you're isolated in any number of ways, particularly because of the mountain ranges. There's no pipelines that go from the Gulf Coast out to California, and you can forget about any being built. So you're going to be really dependent on importation from the Northwest refineries that are left, Alaska, and then Asia, even China you'll become dependent on. And these are long sail trips, big time addition to the price because of that. I don't know what they're thinking out there, Frank. I really don't. Particularly when you think about how much the industry has cleaned up gasoline. They took the lead out literally, and the emissions, the tailpipe emissions, forget the carbon part, are really next to zero. It's been amazing what's been achieved. So it's really going to be a problematic thing. Think of the jobs that are lost. Think of the property tax base that these communities are now going to be losing. I'm really befuddled by it because, they haven't built the bridge to the future yet. I know there's a big push for electric vehicles, and California's got one of the biggest uptakes of it. But, man, there's a long way to go, and these refineries are closing way too soon to avoid really what is going to be an economic potentially shock to the system out there at the gas pump on a daily basis with no relief really ever.
Well, thanks for putting your finger on a huge story here, which we will continue to follow with you, John. Oil industry analyst John KILDUFF at Again Capital and CNBC contributor, longtime contributor to this program. John KILDUFF, thank you very much for joining us live here this afternoon.
My pleasure, Frank. Thank you so much.
Thank you. And now to the freeways now, 790 KABC.
Hey there. I'm Paula Pant, host of the Afford Anything podcast. I help people make the smartest money decisions possible because, let's face it, money's too important to wing it. From investing strategies to economic trends to savvy travel, lifestyle design, and beyond, we're in this journey to financial independence together. Remember, you can afford anything, just not everything. So, afford anything. Follow and listen on your favorite platform.
Mottek On Money continues here, 790 KABC. The Middle East back in focus on day 670 of Israel's war with Hamas, which started after Hamas launched that terror attack on Israel back on October 7th, 2023. Hard to believe the second anniversary of that terror attack is coming up soon. Big meeting in Israel today with the Prime Minister of Israel meeting with senior security officials to hammer out Gaza war plans, and reportedly that meeting ended with the Prime Minister coming out in favor of the military taking control of the entire Gaza area, even if it meant that the remaining hostages could be harmed or executed by Hamas. This according to the Times of Israel. The meeting coming amid multiple reports of rising tensions between the Prime Minister and the IDF chief over the prospect of Israeli forces fully occupying Gaza. Following all these developments very, very closely, joining us live now is Lisa DAFTARI, Middle East expert and editor of the Foreign Desk. Lisa, thank you very much for taking the call, and give us your reaction to this latest news here.
It just seems like this war is dragging on, and we will reach the inevitable which was clear on October 8th of 2023, and that is that Israel must finish the job and finish off Hamas. This is not a sovereign nation, a government to be dealt with diplomatically. This is not, a political fight to be fought. It's not something that could be mediated in Doha between the United States and Israel and Hamas leaders. This is an ideology. It has to be eradicated. This is radicalism. And if Hamas would allow us to hear from the Palestinian people who actually have not been brainwashed, they would tell us the same thing, that they are suffering under the hands of terrorists who only seek to punish them with food and withholding aid, withholding food, not allowing them to have freedom of speech, not allowing them to live, teaching second graders and kindergartners that they must die in the name of jihad. This is what we're watching. And of course, Israel still trying to retrieve 20 live hostages that are still being kept almost 2 years to the day of the attacks. Of course, the Trump administration doing what it can to support Israel, but at the same time trying to wrap up this war. And nobody wants to see war. We see the moderate Arab states in the region as well, trying to wrap up this war and to see how quickly we can see some semblance of stability and peace in the region.
On there live with Lisa DAFTARI, Middle East expert. According to the Times of Israel, looks like the IDF currently holds about 75% of the Gaza Strip. Under the new plan, the Israeli military would be expected to occupy the remaining territory as well, which could put the hostages' lives at risk. According to this report, the Israeli military, they say, has largely refrained from operating in certain areas where it is believed the hostages are still being held. What is your analysis of the status of the hostages?
Yeah, it's awful because Hamas knows that Israel values life, and because of these remaining hostages, they have changed their strategy multiple times to really stop short of going after the target, which is Hamas. And that is exactly why they wouldn't give up that leverage, and that's exactly why they won't release the hostages as we had hoped they will to end this war. And again, I want to remind listeners that this is Hamas's decision. If they wanted to end the war tomorrow, they could. They can give back the hostages, put down their weapons, walk away, and this war would be over. Now, if Israel did the same, there would be no Israel. That is exactly why we call it an existential threat. So having studied this region for over 20 years, I can tell you this ideology cannot be defeated through any sort of time or patience, allowing them to come to the negotiating table, nothing like that. So I do think that despite the fact that these hostages' lives will be at risk, Israel has to now accelerate and to escalate to a point where it has again shown restraint because of those hostages.
What's your reaction to the recent moves by European countries, some European countries, to criticize Israel's handling of the humanitarian situation there?
Yeah, it's very easy. It's lip service, right? It's very easy to blame Israel, but I have never seen a war in which the victim, the one that was attacked, now has to provide aid to the one that is still attacking. But we still, despite all that, we still see that Israel is providing aid. There is plenty of aid, but what people don't see and what the mainstream media withholds and what influencers are not portraying accurately or correctly is that this is Hamas that is standing in the way of the Palestinian people getting that aid. And the European nations, whether it's criticizing Israel or calling for a Palestinian state, on what grounds are they calling? Where would this state be? Who would be governing this state? What would it even look like? It's a very lazy and ignorant solution to a problem that will not be solved that way. It's just, it's the European way. And I think, if you truly want to understand where the region is headed, I wouldn't look to Europe. I wouldn't look to the West. I would look to the East. And I would look at the moderate Arab states who are signatory to the Abraham Accords and how they see the future of the region. They see coexistence with Israel. And the only reason we haven't been able to have a Palestinian state, and many people don't know this, is that the Palestinian people rejected the...
Lisa DAFTARI, Middle East expert, editor of the Foreign Desk. Lisa, wish we had more time, but we'll speak with you again very, very soon. Thank you very much for taking the call here this afternoon live with us here on Mottek On Money on 790 KBC. Stay tuned now for the 790 KBC News Blitz. I'll be back with more at 4 tomorrow afternoon on 790 KBC.
Hey there. I'm Paula Pant, host of the Afford Anything podcast. I help people make the smartest money decisions possible because, let's face it, money's too important to wing it. From investing strategies to economic trends to savvy travel, lifestyle design, and beyond, we're in this journey to financial independence together. Remember, you can afford anything, just not everything. So, afford anything. Follow and listen on your favorite platform.